People often stumble on the notion that both trading and investment can be looked at with equal ease with classical bar charting. There are lots of prejudices against charting in the investment world as well as the trading world, and one reason is that the investment world tends to think of trading as a different sort of activity and amenable to different sorts of analysis. In my view, I stand squarely on the ground that investment is simply low-frequency trading. They are both applicable. What is important is not whether it's low-frequency or high-frequency trading, but the characteristics of the market in question. By which I mean that there are illiquid, oligopolistic, high-frequency trading markets, and there are illiquid, oligopolistic investment markets. What matters is the nature of the market, not whether it's an investment or a trade, in short. At any point, and you hear generals saying this sort of thing, you can calculate in a war or in a market situation, you can weigh up the pros and cons, you bring the evidence for and against a particular decision, for and against a particular action, you've factored in everything. At that point, you simply have to make the leap from analysis to decision making, and that is can be a very wide leap. Getting to the point where you exercise correct judgment given all the factors after the weighing of the evidence. Developing the facility to reach a decision is much more important than so-called correct analysis. A lot of trading and investment literature is devoted to detailed analysis of market conditions and the opportunities that lie within them. They don't devote attention either to the weaknesses of that analysis, when it doesn't work, or to the leap from understanding to decision taking. First of all, I would always suggest that you get a job and learn the trade, because that will not only someone will be paying you to make decisions and develop facilities and skills, but you will benefit hugely from the watching others and being surrounded by a community of traders and thinkers and decision makers, seeing what works and what doesn't work. I think, however experienced, to trade on your own is a very, very difficult path to take. And the reason for that is not that you might not have developed the facility for decision taking, but that you're out of the loop of what you might call the market conversation, or the dialogue, or not dialogue, that's two people, but the general discourse of the market with a whole variety of opinions. And it's often been said, but it's perfectly true, that you need to have a sliver of ice in your heart as a trader. You need to watch the crowd, understand if there isn't a crowd to watch, a crowd of other people taking decisions, then there's a loss of input of information about what the crowd and the psychology of the market is. And you can benefit greatly by listening to other traders. The other traders are part of your crowd. To reduce the crowd simply to price is tough on the individual trader. I think it's great to hear conversations. You may say this goes beyond the bounds of charting, and it does, rather.